I know what it's like. You've looked at your super, you've looked at your other investments and you've thought, oh my goodness, I don't have enough. I need more. But you don't know where to start. So listen into today's podcast because we are going to go through how to start investing, what some of the investments that you could possibly invest in are, and how to ensure that you get the best out of those investments based on your age and your time horizon. Enjoy. Everything we talk about is general in nature. Specific advice to you can only be given by a finance professional. So if you need someone, reach out. Welcome to my happy money journey. I'm Phoebe Blamey, award-winning finance expert and founder, here with practical strategies and inspiring stories to help you take charge of your finances and live your best life. Let's dive in because your journey to financial freedom starts now. The Happy Money Journey team want to begin by acknowledging the traditional owners of the land on which we meet today. I'd also like to pay my respects to elders past and present. Today's episode is sponsored by Entourage Finance and Property. Entourage is a finance and property advisory business whose mission it is to help Australians grow their wealth through property. With services including home loan lending, buyers and vendors advocacy, and car finance, Entourage supports Australians in achieving their home ownership dreams. I wanted to talk today about investments because over the last few weeks we've spoken about so many money-saving things. We've spoken about cash cushions, emergency funds, how to shop smarter, and also we've cleared out a lot around our money wounds and money stories. Getting into what we're actually going to do with that money, I think is really, really exciting. So the very best way to build wealth is to invest your money. And it's always investment over savings. Now, one of the questions I'm getting heaps at the moment is all about this recession and is now a good time to invest my money because we've got money, right? But we just aren't doing the right things with it necessarily. So the Reserve Bank's lowered interest rates. That's great news if you're a homeowner. But it's kind of crappy if you are heavily invested in cash or fixed interest. So if we don't have money that's being invested, we are actually losing money. And I just want to give you a really, really good example of that. In 1990, a Big Mac was worth $2.45 in Australia. Now a Big Mac is worth $7.50. The reason for that is inflation. The dollar in 1990 had much more spending power than the dollar in 2025. And you don't want to get to the end of your working life, realize that you've put everything into cash and it's been earning 1% and inflation's had an average of 4% and you've lost money in real terms. If you're investing, the idea is that your money's working for you. The aim is to build wealth. It's to beat inflation and it's to create options for the future. Options that mean early retirement or starting a business or just not panicking about having enough money. Investing does come with its own risks, and for that reason, I also want to talk about diversification, which is having different assets in your portfolio of investments, and it's really important. And the reason it's important is because it gives you a backup plan. If one of your assets isn't performing well, maybe some of the others are. I'll talk from experience on this one. I've got a $10,000 ETF that I bought a couple of years ago. It's now worth, on paper, $6,000. Now, I'm not about to retire. I don't need that. I'm not going to sell it tomorrow. I don't need anything from that investment at the moment. So as far as I'm concerned, just sit there, be worth $6,000. It's not meaningful to me at the moment. It would only be meaningful if I needed to sell it for some reason. If I'm not selling it, I don't care because I truly believe it's actually in international shares. And I truly believe that it will go up in value again. It has gone down in value as a response to what's going on in different markets around the world. But I knew the risks when I went into it. And I knew that there was not only the general risk of investing in shares, but also the currency risk. So the risk of Australian dollar in international exchange rates. And I can absolutely tell you that over my time, I have made very good investments, but I've made some bad investments. And normally with the bad investments, I just let them sit because I've made such a hodgepodge of it that even selling them isn't worth it. Just let them sit and wait. I don't check my investments every day, because if I checked my investments every day, I would be on a panic. I would be so stressed. I would feel like the whole thing was a wild ride. I only check them occasionally because to me, they are there for a long term. They are a long-term plan. And that's not going to be the case with all the things that you invest in. So if you invest in cash, one of the things that you're probably thinking is that you're going to need it in the short term. And the amount of cash you need in the short term can change over time. It can change with how close you are to retirement. It can change. And the higher the risk, the longer term you want the investment in, and the better the returns. So cash at the bank's a low risk, low return investment. Interest-bearing investments are slightly higher. And shares are a higher risk but higher return in general. So let's have a look at what's important for when we invest. And the first thing that I want to talk about is your time horizon. Because as I said before, I've made some bad investments, but it's okay because I've got time on my side. I'm probably not going to need anything out of that, or I'm going to be able to replace that or fix it or live with it, basically, because I've got another 15 or 20 years before I retire. If I had 5 years, I would be looking at things really differently. And that's where we get into a bit of thinking about diversification. So you may have heard this term before. Diversification is all the different assets that you've got and how much you've got invested in each of those asset types. So asset types could include property, which is your home, the way that your assets are invested, the way that your superannuation is invested. It could also be any collections you've got, like jewellery or art or wine. It is any funds, managed funds, ETFs, index funds that you've got. And it's any cash or cash-like things and any shares. So most people have some sort of diversity in their assets, even if it's just what your super fund has given you and your home. But most people would have some sort of diverse investments. Why do we want to have all of those things and not put everything into one company, one sector, one country, one asset type? Is because a well-diversified portfolio means that if the market's having a turn on one thing, the other part could be having a turn up. Investing isn't gambling. It's about understanding that markets fluctuate and that at different times things are going to be worth more or less to you. But it's also part of your time horizon, because when you move from high risk to lower risk investments, it might be because you want things that are going to be more liquid for you because you're getting closer to retirement, or you want things to be less complicated for you for the same reason. Or you're downsizing your home and you want things to look different. So as we get older, our investment portfolios in general will become more conservative. So we think about that diversification, we think about that time horizon, and what we're doing when we do that is mitigating the risk of us having a big loss or a time when we can't get what we want out of it. And then we want to research what investments we want. Shares, also known as stocks, are a slice of a company. If you buy Commonwealth Bank shares, you're a teeny tiny owner of the Commonwealth Bank. If the company grows, your shares increase in value. If it makes a profit, it may pay dividends, which come from the profit being divided up and sent to you. So you get a payday just for holding them. So 2 ways of making money on shares are they go up in value and you make money when you sell, but you also can get an income from dividends, which are the regular payouts that you normally get twice a year based on the profit of the company. In order to be good at this, you need to research individual companies. You need to know what you're investing in. I prefer, for that reason, exchange-traded funds, which are bundles of shares that you buy in one go. And there are a whole lot of funds out there. So think of a fund like a grazing platter. You've got some cheese, some crackers, some grapes, except in this case, it's a mix of companies. So, for example, you've got some tech companies, you've got some banks, you've got some manufacturing companies, whatever. And those are all put together to make up a fund. Now, there's two types of funds. There's a managed fund, which is where someone is actually researching into all those companies, and because they're doing that, they're charging you a fee for it, and they're charging you a fee for it that reflects, and they're charging you a fee for it. Or you've got a passively managed fund like an index fund or an ETF, which is just a bundle of shares or set against a bundle of shares and still pays you dividends and still has a capital gain and a capital loss when things are bought and sold. But you're not doing the investment. There's no human doing the investment. And my preference for a beginner is always an ETF. There are millions of different ETFs out there. They are my cheese platter of investments. I don't have to think. I don't have to buy and sell. You can get them in anything. So you can get them in global shares, global properties, bonds, anything. Anything can be in an ETF. I think they've even got now crypto ETFs. But whatever it is, set and forget. And ETFs are traded on the stock exchange. Managed funds and index funds are bought directly through the fund manager. If you want to buy things on the stock exchange like direct shares and ETFs, then you need a share trading platform. Now, most of the banks have a share trading platform. There are some independent of the bank's share trading platforms. Whatever your preference is, all of them have different brokerages. And it's worth doing a comparison. You can use Canex. I'll put you a link to use Canex or similar to do a comparison depending on how much you're buying for and how often you're investing or something. It depends. Anyway, you can also go to a human broker who will actually probably help you choose your investments. Now, interestingly, most share trading platforms will have a couple of lessons on how to use it, how to trade, what they do. They may also, and I know because I use NabTrade, have share suggestions and reports about the shares and what they think and whether you should be buying or selling when it's direct individual shares. Now, I don't have many individual shares. I've got a handful of things that I was interested in a few years ago. ETFs 10 years ago were a relatively new thing. That's what it is. Now, then you've got cash and cash-like products, which are cash and fixed interest. So fixed interest might be bonds or mortgage-backed securities or anything that's paying you a definite amount for your investment over a specific period of time. Cash in general, very low risk, very low return, isn't going to give you quite what you get from shares in theory, but it will provide a more safe, more secure investment option. Now, I'm not going to talk about property too much, but just know that there are property managed funds and there are property ETFs if you don't have any direct property investment, and I would include within direct property investment your home. And your home's something that we'd hope would go up in value over time, and particularly a long time, but property, when you're buying an individual property, is more of a long-term investment. Property funds can be bought and sold as ETFs, or you might find managed property funds as well. And we want that kind of diversification. So diversification comes from shares, be they direct or be within a fund, managed funds, cash, and property. And we'd also throw into there's some international investments. So there's overseas investments as well, where we might run into not just the risk of the investment risk, but also a currency risk. We do talk about that on another podcast called Investing, if you want to go and grab that and have a look at it. But just know there are all sorts of risks to investing, so it's really good from beginner to absolute professional. You understand it. No one came out of the womb knowing what an ETF was. I can tell you now that it didn't even exist when I was born. So we've got to be conscious of our time horizon. We've got to be conscious of our diversification. We also need to think about tax, fees, and charges. And so where we get taxed on our investments are when an investment is sold and there might be a capital gain, and where the investment has an income. So be that dividends from companies, interest from a fixed investment, or the return on your managed funds, or rent on a property. Any income we get is taxed. It's taxed at our marginal tax rate. If we earn enough of it, it pops us into the next tax rate. Then it could be taxed at a higher marginal tax rate. Dividends themselves often come with franking credits, which just means that you get a credit on your tax return because the tax has already been paid on that particular investment. It is really important, if you've got any kind of complexity of investment, that you're speaking to an expert, because you don't want things to become complicated, you make a mistake and it ends up costing you money. Be mindful always that tax can impact your investment strategy. When you make a plan for this. Plan your time horizon. Plan where you want your money invested so that it's actually going to make you money, but also so that you're happy with the type and style of investments. When you know your time horizon, you can become more relaxed about a higher risk, higher return, longer term investments. And when we're thinking about savings and savings accounts, we might be looking at a shorter term, more liquid investment. When we think about saving and investment in general, we tend to be quite conservative. And if we are quite conservative, we'll stick with cash or those fixed interest return type things. They're not going to make us as much money as shares potentially. So we might be missing out on something just because we want to stay conservative and safe. But if we think about it from the perspective of our time horizon, we can start thinking differently. Because it's about when we anticipate needing a return from that, what our retirement plan is, what our plan is for the next 5 years, working plan. Assume everything goes to plan. The next thing we need to do is, so we've chosen our time horizon, we've picked our types of investment. Now we've got to pick our platform, how we're going to invest, or know our platforms, because sometimes it's going to be buying direct or banking directly. Choosing how much we want to invest and whether we want to be adding to that investing. And then go ahead, pick your first investment. Schedule in to add to it monthly or quarterly if you want, and check it monthly or quarterly. Don't check it daily. You're investing. You can't keep looking at it as if it's going to be sold tomorrow. Knowing your time horizon should, in theory, make you feel a lot more relaxed around that investment. I know investing can feel intimidating. If no one's ever shown you how, it's really hard. There are lots of resources, lots of things that you can access to find out more about this. But as I said, no one came out of the womb knowing about this. About a compounding effect, about dividends, about withholding tax credits, franking credits. You don't have to be perfect to be profitable, but you do have to be curious. If you are curious, if you're curious with me, if you're curious with your accountant, with your financial planner, you are going to be a more successful investor because you're going to understand more about what you're doing. You have taken a massive first step by listening today. So if you want some more support, scroll through to some of our older podcasts. I will put some links in the show note. Head to our website and check out some of the courses that we've got available. And if you've got someone that would be helped by this podcast, share it with them. And don't forget to like, subscribe, and leave any comments, because we don't want you thinking investment is too hard, because one of my main aims is to close that gender investment gap for you. I know you've got this, and until next week, enjoy your journey. Thank you very much.
Thanks again to Entourage Finance and Property for sponsoring today's podcast. You can find out more about what Entourage can do for you at entourage.com.au.
The information shared on my happy money journey is for general informational purposes only and does not constitute financial, legal, or professional advice. While I am a financial educator, the advice given may not be suitable for your individual circumstances. Always consult with a qualified financial professional before making any significant financial decisions. The views expressed are my own and do not necessarily reflect those of any associated organisation. Listener discretion is advised.